Hello and welcome back to the lesson. The subject is Principles of Auditing. Today we are going to discuss the principles and processes of an audit. Having defined the key terms in our last session, today we are moving to the principles and processes of an audit, which include 1. Integrity, objectivity, and independence. 2. Confidentiality. 3. Skills and competence. 4. Work performed by others. 5. Documentation. 6. Planning. 7. Audit evidence. 8. Accounting system and internal control. And lastly, audit conclusions and reporting. Audit conclusions and reporting. Now, candidates, auditing is guided by fundamental principles or guidelines that ensure its reliability and credibility. For auditing to be reliable and credible, there are certain fundamental principles that auditors must adhere to in order to achieve the credibility and reliability. Auditing also follows a structured process to achieve its objectives. In this lesson, we want to discuss briefly some of the principles and processes. Principles and processes. Now, the first principle or principles, the first one according to our syllabus is categorized into 1. We have integrity, objectivity, and independence. Integrity, objectivity, and independence. Integrity, objectivity, and independence. These are 3 in 1. Integrity is a principle, objectivity is a principle, independence is a principle. These are cornerstones of the auditing profession, starting with integrity. Auditors must be straightforward. Auditors' integrity means honesty, being truthful in all professional and business relationships. Now, to be truthful, to be honest, and to be straightforward means adhering to moral and ethical principles even when facing pressure. That's the meaning of integrity. An auditor is required to have integrity. The auditor is supposed to be truthful. He should not be a liar. He should not be the one who does not speak the truth. He should be the one who is guided by ethical and moral principles. That's the meaning of integrity. Being straightforward, being truthful, being honest, being transparent. That's the meaning of integrity. Then there is objectivity. From the word objective. Auditors should not allow bias or conflict of interest even when facing challenges. Auditors should not be affected by undue influence of others to override their professional or business judgments. They are required to be objective. Auditors must approach their work with impartial and unbiased mindset when making decisions, when planning their work, when carrying out their duties, when executing procedures. Auditors are required to be objective. They should not be influenced by anything, by the management or any other factor. That's the meaning of objectivity. Not being biased, being impartial. Do you understand? Having an impartial and unbiased mindset. That's what we are referring to as being objective. Then the third principle here is independence. Independence. This is one of the most crucial principles for an auditor. especially an external auditor. It requires auditors to be independent in fact. That means the state of mind should be that one that is independent, the one that permits the provision of an opinion without being affected by influences that compromise professional judgment. Auditors should also be independent in appearance, meaning the avoidance of facts and circumstances that are so significant that a reasonable and an informed third party would be likely to conclude that an auditor's integrity or professional skills has been compromised. And independence ensures that auditors' opinion is perceived as credible and biased by users. That's why most external auditors are appointed by the shareholders and not the management. Because if the management was to appoint the auditor, then the auditor may not be as independent as when is appointed by the shareholders. Because here, then the auditor reports to the shareholders and not the management. So an auditor is required to be independent. Independent in fact and independent in appearance. Integrity, objectivity, and independence, these are the cornerstone of the auditing profession. Then the second principle is confidentiality. Now, in the process of carrying out his duties, an auditor comes across the information and records that are confidential to the organization. Auditors gain access, in other words, to sensitive information about the entity that they audit. And the principle of confidentiality dictates that auditors must respect the confidentiality of information that is acquired in the process of carrying out their professional duties. And this principle dictates that the auditors should not disclose such sensitive information to third parties without proper and specific authority. And of course, unless there is a legal or professional right to disclose such information. This principle is vital. This principle is important for maintaining trust between the auditor and the client. Now, some of you are training. When you start to practice, you ensure that information you come across as you are carrying out the work for your client, that information you don't disclose it to any third party unless you have authority to do so. Confidentiality is a principle, is a guideline, is a rule that guides the auditing profession. Let's move to the third point, which is skills and competence. Skills and competence. Skills and competence. Auditors must possess and maintain the necessary skills and competence to perform their professional duties. And this involves professional competence. Professional competence. Professional competence. That means having a sound understanding about accounting principles, about auditing standards, and even relevant laws and regulations, and also the business environment of the audited entity. If you are auditing an entity, you need to understand the industry within which the entity operates, the laws, the regulations, and the general knowledge about the business. An auditor is required to have auditing knowledge, skills, must have competence in international financial reporting standards, the international accounting standards. That's what we're referring to as professional competence. It may also include due care. Due care. That means applying professional diligence and care in performance of an audit And that means, again, acting diligently and in accordance with applicable technical and professional standards. Being diligent. Applying skills diligently. So an auditor is required to have what we call due care. Skills and competence may also mean having what we call continuing professional development. Continuing professional development. Continuing professional development. Continuously, regularly updating their knowledge and skills through training and experience to keep pace with the changes in auditing standards, changes in technology, changes in work environment, changes in laws, changes in business practices, the changes that are always happening in the environment. The auditor has to keep pace. The auditor has to be conversant. The auditor has to update his or her knowledge in order to keep pace with the changes in the environment, because the environment is not static. Everything is changing. The laws are changing, technology is changing, and businesses are changing, technology is changing, everything is changing. So the auditor has to have what we call continuing professional development. He has to continuously upgrade the skills and competence in order to keep pace with the changes in the business environment. So that is skills and competence. 4, we have in the syllabus, the 4th principle or process here is work performed by others. Work performed by others. Work performed. Work performed by others. Work performed by others. What does that mean? Now, while auditors are ultimately responsible for the audit opinion, they often rely on work performed by others. There are times when the auditor may rely on the work that is performed by others. And these others include internal auditors. If you are to audit company A, you may rely on work that is performed by internal auditors of company A. You understand? External auditors may use the work of an internal audit function if they assess it to be effective and reliable. Before relying on the work of internal auditors, the external auditors may assess the work that has been done by internal auditors, and if they find that work to be credible and reliable, they can rely on such work. Another point there is experts. The auditor may also rely on work performed by experts. As much as we say that the auditor should keep abreast with the changes and skills and competence, there are some areas where the auditor may not have the expertise. So the auditor may call in experts to perform certain work, which he then relies on to make his opinion. Auditors may engage or use the work of experts like valuers, like IT specialists, surveyors, and so on. So those are some of the experts that the auditor may rely on in making his opinion. These are specialized knowledge areas where the auditor may not have the competence. But it should also be noted that when relying on the work performed by others, the auditor must assess the competence and the objectivity of these individuals and evaluate the adequacy of their work to ensure it's appropriate for the audit purpose. Number 5, what is the next principle or process? Number 5 is documentation. Documenting work. Documentation. Now, documentation is a critical aspect of an audit because auditors are required to prepare audit documentation, or what we call working papers. This documentation, in other words, is referred to as working papers. An auditor is required to prepare working papers that provides a record of the basis for the audit's report and evidence that the audit was performed in accordance with the international standards on auditing or other relevant auditing standards and applicable legal and regulatory framework. So the only proof that the auditor conducted this work in accordance with the an applicable framework is through the documentation. Everything that the auditor does has to be documented so that when the work is being reviewed later on, that can be ascertained as to whether the auditor carried out his work or her work in accordance with the relevant international standards on auditing and so on. Understand? Documentation is a crucial aspect of an audit. Then number 6, we have planning. Planning. Number 6. Let me have it here. 6. Planning. Planning is the initial and crucial phase of an audit. We know the definition of a plan. A plan is a predetermined course of action. A plan is a predetermined course of action. If you want to do something, you have to have a plan. You determine in advance what you are going to do. So if you want to carry out an audit, then you need to have a plan on how you are going to work out or to carry out the assignment. So planning ensures that the audit is conducted in an effective and efficient manner. And planning includes understanding the entity and its environment. Before you draft a plan, first you have to understand the entity and its environment. You have to understand the environment. You have to gain the knowledge of the client's business, the industry, the regulatory environment. You have to understand the internal controls of the entity. Then you also have to assess risks of material misstatements. When developing a plan, you have, first of all, let me repeat, understand the entity. So first of all, you have to understand the entity you are to audit, the regulatory framework, the regulatory environment, the industry, the internal controls, the business. You need to understand it. Then you have to assess risks of misstatements. You have to carry out risk assessment. You have to identify and assess the risk that the financial statements contain material errors or fraud. Then you determine materiality. You determine materiality. Planning stage, you have to determine the materiality. That means setting a threshold for misstatements that individually or in aggregate could influence the economic decisions of users. Then after that, you can now develop the overall plan or strategy. Develop an overall audit strategy or audit plan. Audit the audit and audit plan. After understanding the entity, after assessing the risks of material misstatements, and after determining the materiality, then you can now come up with an audit plan or audit strategy. That means outlining the scope, the timing, and the direction of the audit, and also detailing the nature, the timing, and extent of planned audit procedures. So you come up with a plan, you identify during the first 1 week, this is what is going to happen. After 1 month, these are the audit procedures that you are going to carry out. You have the procedures in place. You indicate where are you going to start the audit process. Are you going to interview the management? Are you starting the audit by looking at the financial statements? Or how are you going to approach the audit? What is the scope of the audit? Are you going to have audit procedures performed on all the transactions? Or are you going to do sampling of the invoices and the documents? So you have to identify the scope of the audit before engaging on the assignment. So an audit plan outlines the scope, the timing, and the direction of the audit. It also details the nature, timing, and extent of the planned audit procedures. What procedures will be carried out? Is it interviewing the workers? Is it getting information from third parties? Are going to seek confirmation from third parties like banks or debtors or creditors? Are you going to get information from third parties, or how are you going to carry out the audit? That has to be within the audit plan. And that's the essence of having an audit plan. It details the scope and timing and direction. So that's audit planning. Then the next item here is audit evidence. Audit evidence. Number 7, audit evidence. Audit evidence. Now, audit evidence refers to the information used by the auditor in arriving at the conclusions on which the auditor's opinion is best. Evidence is the information that the auditor gathers, which helps the auditor to form opinion regarding the financial statements. Because you need to remember, the objective of an audit is for an auditor to express an opinion as to whether financial statements are accurately presented in accordance with an applicable financial reporting framework. The auditor has to give an opinion. Before giving an opinion, the auditor has to seek evidence that will be the basis for that opinion. And auditors must obtain sufficient, appropriate evidence. The evidence has to be sufficient. So that's one feature of audit evidence: sufficiency. Sufficient means enough. Sufficiency refers to the quantity of evidence. And this is influenced by the assessment of risks of material misstatement and also the quality of such. The evidence must also be appropriate. That's another feature of audit evidence: appropriateness. Appropriateness. The audit evidence has to be appropriate. That refers to the quality of audit evidence. Sufficiency refers to the quantity. Appropriateness refers to the quality of audit evidence, meaning its relevance, meaning its reliability in supporting the auditor's conclusions. Audit evidence should also be reliable. Reliability of evidence is influenced by its source and nature. Reliability. Audit evidence is reliable based on the source. Because we sometimes argue evidence that is gathered from third parties is more reliable than the evidence that is gathered directly from the client. So audit evidence is this information that the auditor relies on to make his or to express his opinion on the financial statement. And audit evidence candidates is gathered through various procedures such as inspection, such as interviews. An auditor will get audit evidence through recalculations, reperformance, analytical procedures, and so on. You understand? Yes. That is audit evidence. Then lastly here, under the principles and processes of an audit, we have audit conclusions and reporting. Audit, before that we have accounting system. Before that we have accounting system and internal controls. 8, accounting system and internal control. Internal control. Now, auditors need a thorough understanding of the entity's accounting system and internal controls. Accounting system. This refers to the methods. This refers to the records established to identify, to assemble, to analyze, to classify, to record, and also report an entity's transactions, and to maintain accountability for the related assets and liabilities. So every organization has an accounting system, which you are saying the auditor must have a thorough understanding of. The system could be computerized or it could be manual. The auditor has to understand the accounting system. The auditor also need to have understanding of internal controls. Internal control system. This comprises the policies and the procedures designed to ensure the orderly and efficient conduct of the business, including adherence to management policies, the safeguarding of assets, the prevention of and detection of fraud and error, and also the accuracy and completeness of the accounting records, and also the timely preparation of reliable financial information. So every organization has internal controls. It has an accounting system. Internal controls, this is a system of policies and procedures that are put in place to ensure that the assets of an organization are safeguarded. An internal control system ensures that fraud is detected and also prevented. And all these candidates, the auditor should fully understand. The auditor should know. The auditor is required to have a thorough understanding of accounting system and the internal control of the company that is required to be audited. Do you understand? It's a very important aspect of an audit process. Understanding accounting system and internal controls of an entity. You understand? So auditors have to assess the effectiveness of internal controls because strong controls can reduce the likelihood of material misstatements, which then allows the auditor to potentially reduce the extent of substantial testing. If an entity, this is to mean candidates, if an entity has strong internal control systems, if an entity has in place controls to ensure that the assets are safeguarded, to ensure that fraud is minimized or does not take place, then the auditor can place reliance on such a system. If an organization has a strong internal control system, then the auditor can reduce his own audit procedures on carrying out to find out if the system is weak or if the assets are not properly safeguarded. You understand? That's why an auditor has to assess the effectiveness of internal controls, because strong internal controls reduce the likelihood of material misstatements in the financial statements. And that allows the auditor to do what? To potentially reduce his extent of substantive procedures. On the other hand, weak controls, a weak internal control system increases the risk of misstatements and necessitates more extensive substantive procedures. So if an entity has a weak internal control system, if an entity does not have strong internal controls, then there is a high likelihood, there is a high chance that misstatements in the financial statements, which now calls for the auditor to carry out more extensive analytical substantive procedures. So that is accounting system and internal controls. Then the last point we need to discuss here is audit conclusions and report. Audit conclusions and report. Number 9, let me write it here. Number 9, audit conclusions and report. Audit conclusions and report. Audit conclusions and report. Now, the final stage of the audit process involves drawing conclusions and reporting. Drawing conclusions and reporting. After planning, after assessing the risks of material statements, after gathering audit evidence through interviews, through substantive tests, through analytical tests, through various means, after gathering the evidence, the auditor has to make conclusions. This is the final stage of the audit process. Audit conclusions and reporting, the findings. The auditor has to form an opinion. Forming an opinion. The objective of an audit is to express an opinion as to the accuracy of the financial statements. The auditor has to give an opinion as to whether the management has presented the financial statements in accordance with an applicable financial reporting framework. The auditor has to form an opinion. And this opinion is based on audit evidence obtained. So based on audit evidence obtained, the auditor evaluates whether the financial statements are prepared in all material respects in accordance with the applicable financial reporting framework. The auditor has to, first of all, draw conclusions, review his work, review the work of the staff. They has to form an opinion before drafting a report. Before doing what? Before the audit report. The auditor expresses their opinion in a formal written audit report. And that opinion can be positive or negative. The opinion can be a clean opinion or modified opinion. So the opinion can be qualified or unqualified. So we may have one unmodified, also known as unqualified opinion. This is a clean opinion, a clean report. So this opinion is contained in an audit report. Here the financial statements present fairly in all material respects the financial position. You understand? A clean opinion states that the financial statements are presented fairly in all material respects. Financial statements are prepared in accordance with the applicable financial reporting framework. It's a positive. The auditor states that having gathered sufficient, appropriate, appropriate, reliable, having gathered enough evidence, it is my opinion that the financial statements of company A, B, C, D portray a true or fair view. They are accurately presented. There are no material misstatements. That is a positive, a clean opinion, unmodified opinion, unqualified opinion. Then you have a modified opinion. Modified opinion. This one is issued when there are material misstatements or limitations in the scope of the audit. And this modified opinion can either be a qualified opinion, it could either be qualified opinion, it could be adverse opinion, or disclaimer of opinion. So modified opinion could either be qualified. This is where financial statements are fairly presented except for specific material items. You understand? A qualified opinion is where all the financial statements items are fairly presented except for a specific item. It could be inventories or it could be receivables. Do you understand? So the financial statements are clean except for one or two items, except for a specific material item. And that item has to be material. So the report here, the opinion says that all the financial statements, all the statements are presented fairly except for a specific material item. But we have also modified opinion we are calling adverse opinion. Adverse opinion. Adverse opinion, financial statements are not fairly presented due to pervasive and material misstatements. This is a negative opinion, which states that the financial statements are not fairly presented because they are material misstatements. If there is a material misstatements in the financial statements, then that will amount to the auditor coming up with an adverse opinion. But you also have this disclaimer of opinion. Disclaimer of opinion: the auditor is unable to express an opinion due to the pervasive scope of limitation. Under disclaimer, the auditor is not able to state whether the financial statements are clean or there is an adverse opinion or qualified opinion. Here, the auditor is unable to give an opinion because of some limitation, or maybe the auditor does not have all the records, or the auditor has a limitation of scope. The auditor has answered, so he's not in a position to give an opinion. So do you understand? So that is audit report. An audit report expresses an auditor's opinion, which could either be a modified, unmodified opinion or modified opinion. A clean opinion or an opinion that we are calling modified, which could either be qualified opinion, adverse opinion, or disclaimer of opinion. So what is critical here to understand, candidate, is that the audit report is meant to provide assurance to stakeholders and enhance the credibility of the financial information. So that is the end of the lesson on principles and processes of an audit. We began by defining objectivity, integrity, and independence. We've defined confidentiality. We've defined skills and competence. There are 3 aspects here: professional competence, due care, and continuing professional development. Number 4 is work performed by others. That others could be internal auditors or external experts. Then number 4, we have working papers or documentation, which is very crucial in auditing. Number 6, planning is a principle. In planning, we've said that the auditor has to understand the entity which is auditing. The auditor has to assess the risks of misstatements. The auditor also is required to determine materiality levels. And then after having done all that, then the auditor can draft an overall audit strategy and plan. A plan is a predetermined course of action. Number 7 is audit evidence. We say that evidence should be sufficient, it should be appropriate. And we did state that sufficiency refers to the quantity of evidence. Appropriateness refers to the quality of evidence. Then the audit evidence is also required to be reliable. Then we've defined accounting system and internal controls. Then lastly, we've discussed audit conclusion and report. The auditor, having gathered sufficient, appropriate, reliable evidence, then the auditor forms an opinion which is expressed in a report, which could either be a clean report or a modified report. A modified report could either be qualified opinion or adverse report or disclaimer of opinion. That is all for today's lesson on the principles and processes of an audit. In our next session, we are going to discuss the differences between auditing and accounting. Bye-bye.